All right, so today we are talking about mortgage rates. Just a quick introduction real quick. My name is Scott Wynn. I'm with the Wynn and Eagan team at Neo Home Loans, and I've got my business partner here, Joe Eagan, who works directly with our clients, and thought would be a great resource to talk about what topic comes up probably more than anything else when it comes to mortgages, which is what's going on with interest rates. So I think the first thing, the way I maybe like to start this out is just by maybe setting some things a little bit straight. A lot of people think that there's a mortgage rate, if you will, right? What is the mortgage rate for the day? And that really isn't necessarily accurate. And I think the best way to describe this and to explain this, and then I want your take on that, Joe, is just talk about and show you what rates are online to give you an idea of what we're talking about related to this. So I'm going to share my screen here and show you what it is I'm talking about. So all right, can you see my screen?
I can, yep.
Perfect. All right, so I just did a quick Google search for mortgage rates. And what I did is I set it at a $500,000 loan amount, 20% down in the state of Hawaii with a 700 to 719 credit score. Most of these are defaults. I just changed the loan amount slightly and the state to Hawaii. What you can see here is the Google is showing as of July 3rd, 7.555% is the average interest rate for a 30-year fixed mortgage. Now, if we look at this and we also compare that to Freddie Mac, they do a weekly survey. And as you can see here, as of the week of June 29th, we're sitting at 6.71%, which is obviously far off from that 7.55% that Google is showing. And if we look at another website, which is called Mortgage News Daily, you can see that this is updated daily. And 30-year fixed is sitting at 7.08%. And even another one, which is Optimal Blue, updated on July 3rd, just like Google was, it's sitting at 6.785. So we've seen 6.785, 7.08, 6.71, and 7.55%. So why? Why does that happen? Joe, from your opinion, working with clients every single day, looking at interest rates every single day, why does this happen, and what's the deal here?
Well, the biggest thing and the biggest reason why you're going to see a discrepancy online is there's literally about 30 factors that go into making what your interest rate's going to be, right? So it's going to be dependent on your particular situation. And again, to your point, when you originally started, there's no interest rate, right? So when people call me originally, usually the first question I get is, what's your rate, right? And my response to that is, what rate do you want? Right? I can give you a 4.75% rate. That's still available. Or I can give you a 7.5% rate. That's still available, right? But it's going to be dependent on your qualifications, your credit score, your down payment. So all of these things that Scott just put up on his screen kind of play a role, right? So when somebody reaches out to me and asks me originally what their interest rate's going to be, that's why my response is it just kind of depends on what you want.
Well, why would anybody not want the lowest possible interest rate they can get? I guess maybe we should
Good question.
For that.
Yeah, because there's always a cost, right? So when we get interest rates, we don't get just one rate for the day. We get a list of rates dependent on each individual's qualifications. So let's say John Smith came to me, he has a 720 credit score, he's got 20% to put down, and I run it, and I can give him a 5% rate. But what that 5% rate's going to come with is what's called discount points. So what discount points are, it's an upfront fee that's going to increase your out-of-pocket, your total closing cost at the time of closing to get a lower rate, right?
Right.
So what they don't tell you, and why some of these rates are going to be a little bit different, and you can go on Wells Fargo, you can go on different websites, and usually what they do is they're going to quote you an interest rate, but they don't necessarily outline the specific costs that come with that interest rate. So you can get a lower interest rate. That just means you're paying a discount point or more money out of pocket in order to get that lower interest rate. Right. Now, that may make sense to do. Now, it depends on the cost associated with getting that interest rate. And we'll talk about here in a little bit what we think interest rates are going to be doing and why.
And it's not like a stair step, right? I mean, a lot of people might think that, okay, for every $1,000 more that I pay, I get a little bit lower interest rate, but it gets compoundingly more expensive to buy down the rate further and further and further, right?
Exactly, yeah. And again, with the state of interest rates where we think they're going, what I'm typically telling people now is avoid paying any points for an interest rate because, again, I don't think anybody that's purchasing now, I don't believe they would be in their mortgage long term, right? Meaning probably once interest rates goes down, and I don't think we'll ever see 2s and 3s again, right? But settle kind of 5, 5.5, somewhere around there. And once that happens, then what we would do is refinance you out of that higher rate and into the lower rate. So if you're not in it long term, you don't want to spend more money out of pocket to have a lower rate, lower monthly payment for something you're not planning to be in long term.
Right. So let's talk a little bit more about interest rates here. I mean, as you can see with Google, they give you some options to kind of play around with these parameters, right? So as we play around with these things, so as Joe was talking, he gave an example of a 20% down payment with a 720 credit score. And compared to what we originally had, which was 7.55, obviously the higher the credit score, the lower the interest rate will be. And so we can go up higher, it's going to go down a little bit further, right? But you can also see that maybe going to a higher loan amount is going to impact things, putting a little bit more money down or maybe
Try
less
that
money down.
15% option. Yeah. Because that's another thing that a lot of people don't realize too, right? Is if you compare a 20% option with a 15% option, a lot of people call us and say they want to put 20% down, which I get, right? But in some cases, we can actually get them a lower interest rate if they just put a little less money down because of private mortgage insurance.
Right. So let's see. So here, a $600,000 loan amount in Hawaii, 780 plus credit score, 15% down to 7.073. At 20%, you can see it's almost exactly the same. And in fact, it's slightly lower with the 15% down. And keep in mind that these, of course, are averages based off of all sorts of different scenarios, the lenders and things like that being surveyed. They do have a bit of a disclaimer here, but all of them do. And they talk about how these are identified and that sort of thing. So you want to look at further about how these rate surveys work and what really goes into them, because almost, I mean, all of these are going to be owner occupied purchases. They're not going to account for second homes. They're not going to account for investment properties and things like that. And Joe, as he explained, there's lots of factors that impact this. And as Joe was explaining, mortgage insurance is one of those things that definitely impacts interest rates. And the reason that 15% down can sometimes impact the rate and reduce it is because of the fact of risk. Rates are based off of risk. The higher the risk of the loan defaulting and the lender losing money, the higher the interest rate. So if you add a little bit of insurance for the lender to protect them, then that's going to reduce the risk. And that's why you're going to see maybe a slightly lower interest rate on a 15% down payment compared to a 20%. So definitely different ways you can strategize there. So any other comments you want to make about interest rates and kind of how they vary and the impact of different factors involved in interest rates?
Not necessarily that. The biggest point that I want to make in regards to interest rate is I wouldn't let that, it drives me crazy a little bit when I hear people try to sell real estate based upon an interest rate, right? I don't think interest rate should ever be a determining factor whether you're going to buy or sell personally. Because you're always typically going to have a housing expense, right? So you need a place to live 99% of the time, you're going to have to pay for that, right? So what I would focus on is the cost versus opportunity, right? Let's go back to COVID. You could have gotten an interest rate in the 3s, right? And that's the opportunity of purchasing at that period of time. But what was the cost? When I hear people talk about a 3% interest rate, I also read a statistic the other day that 70% of people that wanted to buy in that time period didn't end up purchasing because they couldn't, right? Because the competition was too great. So the cost of getting a 3% interest rate, people are having to overpay for a property. I mean, you had to overpay 60 to 80,000 based upon the listing price of the home. You had to waive appraisal. You had to waive your financing contingency. You had to waive inspection, right? So there's always cost and opportunity in every single market. Now, Q to now, interest rates are obviously higher, so that's the cost of purchasing now. But the opportunity that you have is there's not as much competition as there was, right? Another stat that I read is, you know, if interest rates go down a single percent, that will queue $5 million or 5 million more people into the market, right?
Wow.
So there's always that cost associated with doing it, right? So I never like interest rate to be a determining factor on whether you're going to buy and sell real estate. I think it depends on your current financial situation.
and and desire, right? I mean, if you're happy with where
Exactly.
you're at and you don't need to move, then now might not be a great time to move. But on the other hand,
Correct.
if the circumstances are right, you just need more space, you have a job transfer, you retired and want to relocate, whatever it might be, there might be some sort of need and situation that arises. But if you don't need to, then yeah, of course, there's no
Right.
need to make a move. So I think those are
Totally.
great
Yep.
points for sure.
Yeah.
So you mentioned it earlier. Where are rates headed? Where do you think the market is headed? I know one of the things I've talked about a lot in different settings is how mortgage rates are tied to inflation, and that inflation is generally a leading indicator of where rates will go. And we saw that happen when inflation went up. Rates went up right along with it very, very quickly. And we're starting to see some drops in inflation, but we're not necessarily seeing those same drops in interest rates. So can you speak to that a little bit about what's happening there?
Yeah, so the biggest thing is the Fed is trying to get inflation under control. And to the points that you made earlier, obviously mortgage rates are tied to inflation more so than anything. Inflation is starting to come down, and the Fed is obviously looking at that. But one indicator that they're looking at is called the PCE report, the personal consumption report, right? So that's going to go into housing, food, things like that that people spend every single month. So the biggest thing that isn't going down at the rate that they want to see it is housing expense or renting expense. So, and usually kind of, as I'm sure you brought up in previous, is there's always a lag to what the Fed is doing, unfortunately, right? They deal with numbers, but they don't necessarily deal with it as is. So the PCE report it started at the beginning of the year at 5.4%. Last quarter, it went from 4.7 to 4.6%. So it's going down and we can see that decrease. But what the Fed wants is they want it at 2%, and they want it there now, right? So
So they're
that's why
taking
they're
action to do that.
anticipating. Correct, exactly. So that's why everybody anticipates there's going to be 2 more rate hikes. Everybody's anticipating one in July and then again at the next meeting.
Let's
Now,
talk
how
about
much
that
they
real
do?
quick.
Okay,
So when the Fed increases rates, and I know we talk about it in many situations where the Fed rate is not tied to the mortgage rate
correct.
necessarily, but there might be some people that be watching this that aren't familiar with that. So when the Fed increases rates, what's happening? And is that the Fed increasing mortgage rates? So can
It
you
is
speak to
not.
that a little bit?
No. Yeah. So when the Fed increases rates, what they're doing is they're raising rates for more short-term debt, not long-term mortgages, right? So what they're doing is they're raising rates for credit cards, car loans, things like that, right? To help kind of slower spending. That's their goal by raising the rates. So what they're doing is they're raising short-term debts. Now, it does impact mortgage rates. And usually on the day that the Fed raises the rate, it's already been pre-built into mortgage rates, so to speak, right? So they're kind of anticipating that rate hike. Now, again, it's not a correlation to raising the mortgage rates, but usually it does have an impact on rates, and that's kind of pre-built into what interest rates we offer for that particular day. But what's funny is usually when rates increase or they raise them, mortgage rates will get slightly better for that particular day.
It is interesting because I mean everything's tied together, of course, right? I mean,
Right.
the economy is tied into the world now because of the world economy that we live in, and mortgages are tied into consumer spending, and consumer spending is tied into interest rates. And so all these things, of course, are interconnected, but they're not necessarily directly related the same way that the Fed's rate is to credit card interest rates or auto loan interest rates. And I think that's exactly what you're pointing out is that that's the short-term type debt versus the long-term debt. But because of the way in which the economy impacts one another and where people put their money in times of uncertainty, then that's going to possibly drive up bonds and therefore mortgage rates and kind of cause things to happen that way. And so that's exactly what
Sure.
you're talking about. Is that rates will generally tick down, mortgage rates will tick down when
Sure.
the Fed increases rates. So,
Now let
just
me ask you, I know you and I talk, right?
yeah,
Where do you think rates are headed?
I think rates are headed down. I do. I think that To your point, there's a bit of a lag that the Fed is maybe not taking into consideration. And the fact that inflation hasn't come down as significantly as maybe we would have all hoped or expected at this point is largely due to the housing expense. And if you think about it, just on a logical situation here, is that housing is a very long-term type situation, right? When somebody, let's just talk about rents, not even buying a home, but if you think about renting a home, generally you're going to sign a 1-year lease, right? So as inflation was going up and the cost of things were going up, landlords were increasing rents. And so they were locking people into 1-year leases at higher and higher and higher rates. Well, as inflation has started to slow down, not nearly as quickly as that went up, those leases are being renegotiated, but they're not necessarily happening at the same pace at which it went up because of the fact of how those long-term leases exist. And the other thing that I should maybe mention here is that it's kind of like an accelerator, right? So when we talk about inflation, that's the pace at which things are increasing. So it's not that we are actually deaccelerating at this point. We're just accelerating at a slower pace than we were before. So it's not that we can expect that rents are going to go down or housing costs are going to go down. What we can expect is that they just may not be increasing at the same level that they were. And so
Which
that's
is to
also
be
something,
expected, right? Because
right?
over the last couple of years, home prices have been increasing at an amount where hindsight is 2020. We should have all bought 30 properties,
Yeah,
4 years ago, right?
exactly.
So yeah,
Got it. So forecast, you think, where do you think we're going to end up and when do you think we're going to end up there as far as mortgage rates?
great question,
Yeah,
right?
if only we knew, right?
Right, exactly. You know what's funny, because everybody had May 10th kind of circled on their calendar in the mortgage industry, because that's the date previous inflation numbers were going to drop off, indicating inflation was lowering, right?
Yeah.
And little did we know, used car prices were increasing, and again, it's a lot of supply and demand and things like that. So I think two things we've got to look at going forward, and that's job reports or a recession, unfortunately, right? I think those are going to be the indicator. And do you have the slide where it shows recessions and what interest rates typically do in a recession? Because not only do they follow inflation, but in 6 of the 8 total recessions that we've ever had, mortgage rates actually decreased. Now, depending on how you view a recession currently, some people may say we're already in a recession, although I don't think that's going to be said at this particular period of time, right? But those are the two biggest indicators to me on what interest rates are going to do. Is either the job report, unfortunately, I think unemployment's going to have to come in a little bit higher than what is expected, or a recession is either Q3, Q4, enter the recession based upon kind of what the government deems the, recession. And then I think we will see interest rates decrease at that particular time.
This is the chart Joe is referring to, showing historically the blue line are rates and the gray periods of time are the recessionary periods. And you can see that rates dropped during all these great periods of recessions. And so recessions definitely lead to lower interest rates when that happens. So like you said, I mean, based on employment rates or unemployment rates and recession forecasts, as well as inflation, I mean, those are all the things that are going to be impacting us. And everything's pointing to the direction that we're going to likely see a recession because the Fed's going to put us there by increasing interest rates to lower inflation. And so between the fact that we're going to likely see a recession and that inflation is going to drop, it's expected that we're going to see interest rates come down. So
Right.
that's our best guess. Obviously, no one knows what the future holds. There's lots of things that can impact the economy, the world, consumer spending, inflation, and of course, mortgage interest rates. But there you go.
But to point that out, right? That's one thing. And again, I know you've talked about this on previous calls with Julie and her team, is our certainty guarantee, right? That's why we put our certainty guarantee in place, which means if you purchase now, what we don't want to do is have people wait for interest rates to decrease, because again, to that stat that I read earlier, lower interest rate would bring 1% in interest, lower interest rate would bring $5 million or 5 million new people into purchasing a home, right? Which is going to bring more competition, which again will be overpaying for a property, overbidding for a property, waiving inspections. We don't want people to wait for that, right? And again, you're probably not going to be in a mortgage for 30 years, to be realistic. So what we did is we put our certainty guarantee in place to where if you purchase now within a 24-month period of time after you close, we will refinance you for free when interest rates do decrease. And for every client, we watch that, right? We monitor that for you. We have certain triggers within our system that would tell me when it would make sense for you to refinance at that particular period of time. So, and Scott's bringing that information up on the screen now.
Exactly. So make a home purchase with us, get your mortgage through us. You'll get that opportunity to do a no-cost refinance. And when we talk about a no-cost refinance, I should clarify just that there are no closing costs that we will charge as a lender to complete that refinance. There are many lenders that will advertise a no-cost refinance, but what they are actually referring to is rolling those costs into your interest rate. So there is not a cost to you at the time of closing. To get that. We will not do that in this particular case. We will cover those actual costs for you. If you'd like details about that, please let us know. We'd be happy to send you this information so you can check that out in more detail. Now, we do have a few questions that came in for this, and so I just want to run through these questions here. So there's somebody that is has a house that's paid off, and they're saving for a down payment on another home in Kona. They're not sure if they want to sell their house that they have and use all those funds to buy the next home, or if they should rent out the home that they own currently and use that income to help then put a down payment on a home so they can have both houses. So what are your thoughts there?
My thoughts are it depends, right? It's going to depend on your expectations on what you want moving forward financially, right? Do you want to keep a home and rent it out that's going to earn appreciation and also help supplement some income as you do that? Or would you rather liquidate that asset to put more money down on the next home and ultimately yield a lower payment, right? So for me, that's a tough question because it really depends on what you want to accomplish, right? Is there a favorable mortgage if you rent a home in Alaska? No, it's not going to be a more favorable mortgage, but could you qualify for more? Possibly, right? Because what I can do then is I can take that home in Alaska that you own free and clear. I can take a lease on that property and use that for income in order to help qualify for the next home in Hawaii, right? So by using that rental income, what it will allow me to do is you obviously have more income that I would be able to use to help increase your purchasing power in Hawaii. But in the same breath, if you liquidated the home in Alaska, that means you're probably bringing more money to the table in a home in Hawaii that you can then put down on your home and ultimately purchase more in Hawaii as well, right? So is there one favorable over another? In my situation, and I'll let you speak to this here in a minute, I would not want to be a landlord, right? Especially being in Hawaii and having a home in Alaska. Now, obviously, you can pay management companies to help that as well. But what are your thoughts on that?
I think I can see it both ways, right? I mean, to your point, you can use the rental income and you can increase the income that you have to qualify for a larger monthly payment. And let's clarify, we're qualifying for a larger monthly payment. But also to your point, if you don't have the assets that you're taking from the sale of that home, then you can't put it towards the down payment on the home in Hawaii, which means you have to have a higher payment because you're financing more.
Right.
So I think it's really
But your rent's going to help offset that payment, right?
Right. So I think it really depends on your individual tolerance for risk to a degree in terms of owning two properties and what that risk is in terms of long-term maintenance or repairs or things that may come along there, vacancies. with being a landlord, but I can also see the benefits of having two homes and having both of them appreciating over time. And there may be some ways we can pull some of the equity from the existing home to use it for a down payment on the other home. So that's probably more of an individualized conversation to be had, but hopefully that gives people some idea of kind of the pros and cons of each direction. So,
Right. Yeah.
Another question related to property taxes in Hawaii. So when we qualify people for a home purchase, we always look at qualifying based off of a monthly payment, and that includes
Right.
principal, interest, taxes, insurance, mortgage insurance, and HOA. And so the question here is talking about how the payment is just a bit out of reach, largely because the property taxes can make an impact on the monthly payment. So the property taxes could be the final decision on if we can comfortably afford the mortgage. The property taxes in Hawaii seem to be confusing as they are based on many factors. How do you calculate the taxes when you, the lender, decide how much my house costs each month to determine the mortgage amount? And can you share some information about where you get your calculations?
Yes. So, and it gets a little tricky in Hawaii, right? Because as if you're looking to purchase in Hawaii, you can see drastic changes with property taxes in regards to if you owner occupy the property or the seller actually owner occupies the property. So for qualifying, let's talk about that first, because when we're dealing with property taxes, we're actually dealing with property taxes based upon how the seller of the property has occupied the property, right? So they can be significantly cheaper if you're actually purchasing a property from somebody that actually lives in the property versus somebody that doesn't. Hawaii actually has the lowest state property tax rate out of any of the other states, but that's if you're purchasing from somebody that owner occupies the property. Now, in time, you can file for an exemption once you actually purchase the property, if you're going to be living in it, to lower the taxes if you've purchased from somebody that has it as a second home or investment property. But to answer the question directly, where I come up with the calculation is just based upon doing this since 2006, honestly. What I do for a pre-approval purpose is when I'm calculating property taxes for qualifications, knowing that tax rates in Hawaii, if you are purchasing from an owner occupied, are about 0.35%. What I do from a qualification standpoint is I take 0.6% from a property tax standpoint. So 0.6% of your purchase price divided by 12, add that to your mortgage payment. That's essentially what I use for a property tax calculation. Now, in some cases, that can be a little bit high. And honestly, in some other cases, it could be a little low. But what we do for the pre-approval standpoint is once I issue the pre-approval, it's kind of for that particular, like Scott alluded to. One thing is, if I issue a pre-approval at a $600,000 purchase price, that purchase price really doesn't mean much. It's more towards that monthly payment. So what we do is I want to run numbers on any property once you're interested, right? Because even an HOA in Hawaii can change drastically based upon kind of a condo complex that you're purchasing, not only property taxes. So what I want to do is the property taxes HOA can be a determining factor in some cases if we're really pushing the limits on a pre-approval. So what I want to do is before you even submit an offer, reach out to me, and typically Julie and her team will reach out to me because we work directly together. And what I will do is be able to run exactly what the property taxes are on that particular property. All I'm doing is pulling them up from the county, but I will research that ahead of you submitting an offer so that we know going into it, what's the maximum you could qualify based upon property taxes, HOA, all of that.
So I had a couple of things.
Okay.
Every property's property taxes are available online. So
Right.
you look up the county tax records for a particular property, you plug in the address and it tells you what it is. That's what we're going to use for qualifying purposes. So if you want to do that yourself, you could do that. We're happy to do that for our clients. That's what Joe's talking about when you're ready to submit an offer or find a house that you're interested in. So that's one piece I wanted to add on. And the other piece is that the way the question was phrased, and I think this would go for anybody that's searching for homes, is that it started out by saying we found a home we love, but it's just a bit out of reach for us. And I will say that Hawaii specifically, but everywhere nowadays, there's so few homes available. If you find a home that you love that's just slightly out of reach, my suggestion would be, honestly, to get that home. Because if you pass on that home, it may be another 3 months, 6 months, 9 months, 12 months or more before you find another home potentially that fits what you're looking for. And I'll point out that if you were to wait and rates do drop as we anticipate they will, and more people flood into the market, that's going to increase demand. And therefore, with supply being low, it's going to increase prices. How much are prices going to go up? And therefore make more homes out of reach for you, not because of property taxes necessarily, but just because of the fact that prices are going up faster than what maybe you can keep up with. So just factors to consider when you're debating on whether or not to move forward with a home versus not, and the impact that time may have on those things. So
Great point. Yeah. And as long as you can qualify for it too,
of course.
right? We've got to make sure you can qualify for it. But yes, great point.
Last question we have here. Bought a condo 2 years ago. Thinking of selling and moving to another condo in Kona. How much will it cost me in loan fees if I pay off one loan and now have to get it into another? Especially if I had a rate of 3.5% and now it's in the sevens. For a $450,000 loan payout and a gain of $50,000 in equity over the past 2 years, does it make sense to move? So I'm gonna give my 2 cents and then Joe
Sure.
jump in here. So I honestly think that the cost of buying and selling is largely impacted on the real estate side more so than the mortgage side. Yes, there are loan costs associated with making a move, but in comparison to the cost of the real estate transaction, it's far less. And at the same time, kind of going back to the last comment I made, is that if a house is not suiting what you want it to be, and you want to make a move because it's going to improve your quality of life and those sorts of things, then I think it's really more of what is your quality of life worth financially to you? Is it worth a cost of X amount, whatever that amount is, for you to make that move, independent of whether or not the payment's going to be a little bit higher or whatever it might be? So, so that's, I guess, my 2 cents. But do you want to maybe elaborate a little bit on what mortgage costs are and your opinion on that as well?
Yeah. So like to your point, right? You're going to have more real estate fees in selling a home than you would mortgage fees. Mortgage wise, you're really not going to have any fees in regards to selling your property, right? Now, there are closing costs that are when you go to purchase a new home, but you're talking 3% of the purchase price, somewhere around there, probably a little bit less depending on the property you find. So there are going to have some fees, right? But I wouldn't let that be a deterring factor. And to your point too, again, what would you say to the point if she has a 3 or he or she has a 3.5% rate, rates are now sevens, what would you say to that point?
Again, I think it goes back to what's important to you. And obviously, this is not even something that would be being considered if you were just factoring in what the monthly payment would be. Even if you made a lateral move because the condo you don't want is just in an area, let's say you don't want to be in, and you want to be in the same price condo, but in a different area, and it's the same price, but you know your monthly payment's going to go up because interest rates are more expensive, then I think it's just a question of what's it worth. And keeping in mind, of course, we do have that certainty guarantee. So rates might be a little bit higher now, and within a couple of years, hopefully they come down, probably not to the 3.5% level, but that could help reduce your costs a little bit there. But if it's something that means that much to you, then I'd say go for it. There's more important things than potentially money. And I don't say that lightly. I realize that money is a strain for many people, and it's a huge consideration that needs to be factored into the decision. But at the same time, in this particular case, I think it's clear that this individual wants to make a move, and it's just a matter of seeing if it makes sense to do so. And I think that as much as there is a logical financial aspect of buying and selling homes, there's also a very big emotional aspect that has to be considered as well. And those two things need to be balanced based on each individual situation. So
yeah. And one thing that excites me about this particular question is I get the 3.5% interest rate to 7%, but what I don't know is I don't know what the rest of your financial picture looks like, right? So you earned $50,000 in equity over the last couple of years, although you're going up in rate. Could we use that $50,000 to allocate to pay a higher interest debt to maybe your total cash flow goes down, right? So from a qualification and doing loans on a day-to-day basis, that's kind of a scenario that excites me, right? Because what we want to do is not just take your order and say, okay, this is kind of the right situation. We want to look at everything. We want to look at your financial picture and make sure that we're getting you into the best mortgage that fits that financial picture, right? So if we can allocate some of those funds, that $50,000 that you just earned, to pay off higher interest debt, max out 401k, set aside for school, for kids' student, school funds, things like that. That's the type of stuff that excites me more than I'm going from a 3.5% interest rate to 7%. Okay, get that. That sucks, right? But can we use that to put you in a better financial picture?
Yeah, great points. Because I mean,
Yeah.
I would say over 50% of the time when we sit down with a client to talk about what they're looking to do and how they're looking to accomplish it, we can uncover some situation that they hadn't considered that can improve their financial position, even if we are going up an interest rate from where they are to where they are going to be based on the current interest rate market. And there's lots of different ways that we can look at that. And I would just encourage anybody who's in this type of situation to give us a shot at stepping through that. There's no expectation, no cost. It's what we call our certainty consultation to go through that process so that you can gain the certainty in your decision as to whether or not it makes sense for you to make a move like this. So
Yep.
love the opportunity to talk with anybody who's interested in doing that. Anything else that you want to share related to the current mortgage market, interest rates, anything like that?
No, I'm just excited to be on this. I know you and Marla kind of more have been the face of our team in Hawaii, right? Although usually when people get to us, they talk to me, right?
Yep.
So I'm just excited to be on this and kind of put a face to the voice,
Right.
although maybe nasally at times. But I'm just excited to be on here.
Well, thanks for joining me for the conversation. If anybody has any questions, we'll have links to our website, things like that. You can reach out to Joe anytime. He can be reached at 888-231-2444. That's our number. Just call or text us anytime. Love to help you out. If you need any more details about the certainty guarantee or the certainty consultations, we'll have links to all those as well. So thanks for watching.